These are the top 5 scams that social media gurus are feeding to you, and I'm here to debunk them and also tell you how you can actually apply them legally. My name is Anna. I am the owner of The Tax Boss, a virtual CPA firm where we help clients all over the country play the IRS game just like wealthy people do. So let's get right into the video. Let's start with a really easy one. Number 1, it is writing off your dog. How many times have you seen on TikTok or social media saying, you can write off your dog if they're a guard dog? And let me tell you how you can actually do it legally. Number 1, yes, you can have your dog be a write-off as a guard dog. But unless you are a cattle raiser and you need these dogs to help you guard your cattle or I don't know, any other farming that people do, I don't think that you as a realtor you need a dog, especially like a golden doodle, protecting your office. No one's stealing anything from you. Now, if you're a drug dealer and you have like drugs in your trap house, maybe you do need a dog to protect that. But 99% of us are not going to be able to write off our dogs as a guard dog for our businesses. Now, there is a way that you can actually write off your dog if you need it for medical purposes. So let's start with the basics of how to write off your dog or medical expenses on your tax return. Number 1, you need to itemize on your tax return. And if you don't know what that means, it's the government gives us a standard deduction or you can itemize. This year in 2025, if you are single, the standard deduction is $15,000. That means that let's just say you needed a dog for medical reasons. You're going to have expenses that are itemized over $15,000. What do those include? Those include like property taxes, charitable deductions, and medical expenses. But here's another trick. Medical expenses will only be deducted when they are 7.5% above your adjusted gross income. So in other words, let's give an example. Let's say your adjusted gross income is $100,000. Your medical expenses, the first $7,500, don't count. Anything above that will start adding to your itemized deduction. But again, remember that $15,000 standard deduction? You're going to have to go above that $15K and then some in order to itemize. So yes, your dog can be used as a medical expense and anything that goes along with the dog that you need, whether it's training because they need it because you have some disability, all of that can qualify for medical expenses. Number 2, writing off your entire outfits, your Gucci's, your Pradas, everything that you have on as an attire, people want to tell you that they can write it off. And unfortunately, that's not the case. So let's start with some basics. In order for you to take a deduction as a business owner, it needs to be ordinary and necessary. I don't make the rules. That's just what it is. That means that Anna, here recording, I can't write off this shirt. Okay, because I would have to prove that this shirt is only exclusively used for recording. And well, that's going to be a little bit hard, right? Now, I have some clients who are in the adult industry. Now, that's going to be a lot easier for them to prove some of those risque clothing that actually they need in order to generate revenue. A very tricky one is for my influencers who are personal trainers. All your Lululemon, Aloe, athletic wear that you want to use, you want to write it off, right? And it's a really gray area. My suggestion here is talk to your CPA, but what I have seen actually works a lot is if all of your attire has your logo, it is a lot easier for us to prove that you're only exclusively using it for when you are training and generating revenue, as opposed to you're just going to Lululemon, dropping a couple $1,000s and saying that you're exclusively only using it for training. That's going to be hard. So when it comes to attire, it does become really, really hard. Number 3 is funneling all your income and expenses into a trust. There are 2 types of really famous trusts. First one is a revocable trust. A lot of times this is set up for liability purposes. And what it means is that during your life, you can actually change what's in the trust. That's why it's revocable. Right? That does not mean that you put all your income and all your expenses from your business and then you're no longer paying taxes. That's not how it works. An irrevocable trust is going to most likely file a tax return. Now, trust and individuals have their own tax brackets. And to be quite candid with you, if you are here learning about what an irrevocable trust is, we don't need it. to be in a nice way. We would have already had our trust fund parents talk to us about that. And there's no shade there. I'm just saying that what we're trying to debunk here is making sure that you don't do these wrong things just because you saw it on social media. Number 4 is taking expenses if you're a W-2 earner from your job. The amount of times I have seen this, I have also seen tax preparers talk about this online, and this is illegal, okay? If you work for Chase as a full-time W-2 job, you are not allowed to take any expenses against your W-2 job for the expenses that you might have incurred because of Chase. So for example, let's say you have to take the train because you have to get to the office, not a write-off. I had another client who was working in the oil fields, and his preparer said, hey, you should take off all the boots that you need, all of the driving that you're doing back and forth, because it is obviously like oil fields, like you travel places. That's not a write-off, okay? These are not write-offs. So if you're a W-2 earner, you are not allowed to take any losses or expenses against your W-2 income. Very little amount of time that can you actually do that. And it's like if you're serving for the military and certain little jobs that you are able to do that. But most of us cannot. And the last one is if you own rental, you can write off all of the losses against your W-2. So this is a little bit more intricate that I can just get through this video. So here's a video where you can watch how to qualify for real estate professional status, which is actually what you need to do. So let's break it down. If you make over $150,000 and have a full-time job and you have rentals on the side, you're not going to be able to take any of those losses against your W-2 income. I have a lot of high net income earners, such as physicians, attorneys, who literally see someone on social media tell them to go get a long-term rental. And then when they come with me to get their taxes done, they said, well, I'm going to be able to see all these losses against my $1 million income. And I'm the bearer of bad news to unfortunately tell you, you cannot do that. There's more to this law than the social media gurus are telling you. And it is very important that you do not go invest hundreds and thousands of dollars in rentals for tax write-offs. I hope this video was extremely helpful. If you like it, please make sure to subscribe, share it with others so that we can continue to make videos to just show people how to play the IRS game just like wealthy people do.